All right, let's get right into it. Today we're looking at a classic showdown. It's the new hotness versus the old guard, a high-tech AI fund taking on the entire US stock market. This is really a tale of two completely different ways to think about investing, and we're going to see it all through two ETFs.
So here's the billion-dollar question, right? Who actually comes out on top? Is it the super sophisticated artificial intelligence that's trying to outsmart everyone? Or is it the simple, straightforward fund that just buys and holds the 500 biggest companies in the US? Let's meet our contenders. So first up, in the Challengers Corner, we have the Draco Evolution AI ETF, ticker DRAI. Now, this is the new kid on the block. It just launched in 2024, and it's coming in with a really ambitious goal. So what's the big idea here? Well, DRA is what we call an active fund. Its AI brain isn't just mindlessly buying stocks. No, it's constantly scanning the entire economy to move money around between different kinds of investments. One month, it could be all about stocks, but the next, it might pivot hard into gold or bonds, all in a constant effort to chase profits and, just as importantly, dodge those nasty downturns.
Okay, that is the million-dollar question, isn't it? How does this AI actually decide what to do with all that money? It's not just pulling levers at random. There's a very specific process it's designed to follow.
So here's how it works. First, the AI looks at all the big picture economic stuff, inflation, interest rates, that kind of thing. Then it crunches what it calls its own proprietary kind of secret sauce micro indicators. Based on all that analysis, it decides which asset class, stocks, bonds, gold, whatever, looks like the best bet at that moment. And here's the really crucial part. It doesn't buy individual stocks like Apple or Tesla. Instead, it gets its exposure by buying other ETFs. It is literally a fund made up of other funds. Now, this is where it gets really interesting. Look at what this AI is actually holding right now. You'd think an AI fund would be loaded up with tech stocks, right? But nope. Look at this. It's playing defense big time. We've got almost 30% in a US dollar fund, basically cash. Another 25% in gold and over 31% in government bonds. But at the same time, it's making this really aggressive, punchy bet with that smaller slice of leveraged stocks. It's a very strange kind of barbell-style portfolio.
And here you can see that fund-to-fund strategy in the flesh. DRA's biggest holdings aren't companies at all. They're other ETFs. You can see TQQQ, which is a wild ride that tries to give you 3 times the daily performance of the NASDAQ 100. You see SPXL, which does the same thing for the S&P 500. And then you see the funds for gold, for long-term bonds, for the dollar. This isn't a broad portfolio. It's a small number of really big tactical bets.
Okay, now let's pivot to the reigning champion. This is a household name for a lot of investors. The Vanguard S&P 500 ETF, ticker VOO. And you know what? This is about as classic and traditional as you can get. VOO's entire philosophy is the polar opposite of DRI's. It's a passive index fund. There's no genius AI, no frantic trading, and absolutely no attempt to predict where the market is going next. Its one and only job is to buy the roughly 500 stocks in the S&P 500 index and give you whatever the market gives you. That's it. It's simple, it's transparent, and it has been incredibly powerful. And when you crack open the hood on VOO, you see a totally different world from DRI. Instead of a mix of gold and bonds and cash, you just see the different sectors of the US economy. And what's absolutely crucial to notice here is the massive weighting toward information technology. It's over a third of the entire fund. Then you've got financials, consumer goods, and so on. This is just a pure snapshot of the modern American stock market. And of course, VOO's top holdings are the names you and I see and use literally every single day. NVIDIA, Apple, Microsoft, Google, these absolute giants make up a huge chunk of the fund simply because they're the biggest companies out there. The contrast with what's inside DRI could not be more dramatic. Okay, so we've met the fighters, we know their styles. Now for the main event. How have they actually performed? Let's put them head to head and see what the numbers say. And whoa, looking at the last year, the results are kind of shocking. Drai, the AI challenger, put up a massive 30.9% return. That's nearly double the 16% return from the S&P 500's VOO. It really looks like the AI's big tactical bets paid off in a huge way. So round one definitely goes to the challenger. But hold on a second. One good year doesn't tell the whole story, right? When we zoom out and look at the 5-year performance, the picture changes completely. VOO has this long, proven track record of delivering a fantastic 16.4% per year on average.
Dry, because it's brand new, well, it has no 5-year history. So the takeaway here is that VOO has consistency on its side, while Drai has had a spectacular but very, very short debut. Now, you have to figure that having a super smart AI managing your money and trying to get those huge returns, well, that's got to come at a price, right? Let's talk about the fees. To get DRA's AI on your team, you're going to pay an annual fee of 1.34%. Now, to put that in perspective, for every $10,000 you invest, that's $134 coming out year after year. That's a pretty significant hurdle the fund has to clear just to keep up with a cheaper option. And here is that cheaper option. VOO's annual fee is a ridiculously low 0.03%. That's just $3 a year for every $10,000 you invest. Let me say that again. $134 versus $3. Drai's fee is about 45 times higher than VOO's. That is a massive, massive difference that can really add up and eat into your returns over time. So here we are. We've got this high-cost, high-flying newcomer against the super low-cost, steady champion. How in the world are you supposed to choose between these two? Let's try to break it down and make it simple. This tale of the tape really sums it all up, doesn't it? On one side, you have Drai. It's active, it jumps between different assets, it holds other ETFs. It had an amazing first year, but it's totally unproven long-term and comes with that very high fee. Its biggest risks? Well, what if the AI model is just wrong? Or what if that leverage it uses blows up in its face? Then you have VOO. It's passive, it just holds stocks, it has a fantastic long-term track record, and it's dirt cheap. Its risk is simple. It just goes up and down with the rest of the stock market. So who is each fund really for? Well, DRAI is probably for an investor who truly believes that a sophisticated AI can consistently outsmart the market. It's for someone who's willing to pay that premium price for an active, adaptive strategy. VOO, on the other hand, is for the classic long-term buy-and-hold investor, someone who just wants a simple, incredibly low-cost way to own a piece of the entire U.S. economy and just let it grow over time. And that really brings us to the final, most important question. This is the heart of the whole debate. When it comes to your own money, what's the smarter bet? A brilliant, complex algorithm that's trying to find an edge, or the slow, steady, collective power of the entire market? There's no single right answer, but it's a choice every single one of us has to make.